Everybody has a narrative, but rarely are those right. People say that when oil prices are high, the stock market should be crashing, the economy should be going down. But that's obviously not what we are seeing. Have a look at oil prices at the top, WTI, and have a look at the S&P 500 at the bottom. Prices shot up after the initiation of the Iran war, but since we got those elevated prices, the S&P 500 performed quite well. It returned 14% in the span of just 3 months. So what is going on here? Are oil prices actually that high in the grand scheme of things, historically speaking? Have a look at this chart over here. This is US oil, and yes, when we are close to $100, that's much higher than say 100 years ago. There was a time when a barrel of oil was trading for $1, not for 100. But there was also a time where an ounce of gold was only $20, not 4,000. And yes, the S&P 500 once was at 7 points, not at 7,000 points. So there's something common going on here. All of those charts share the same denominator. We've got our asset, and that's measured in US dollars. And the number of US dollars is going up over time. US money supply is growing on average by 6.8% per annum. And so how bad is the current oil price really? Is this potentially the next oil shock? We can only answer that question when we look at US oil relative to the monetary base. The oil crisis was in the 1970s. Again, Iran was involved. And here, oil relative to the money supply went up by more than 500%. Over the decades, oil tends to actually get cheaper over time. We've got lower lows, and even the crises tend to be less severe relative to the money supply. And this here is our recent quote-unquote oil shock. We are very far away from a crisis. And that, at least partially, explains the disconnect. That's why even comparatively elevated prices, even when oil doubled in the last year, the S&P 500 is still able to grow. Now let's have a look at how strong that connection in general is. So when energy prices go up, how harmful is this actually for the stock market? Let's compare US oil versus the money supply and US stocks versus the money supply. So again, at the top, we've got the oil price. At the bottom, we've got the S&P 500 relative to the money supply. This year was the dot-com crisis. This year was the global financial crisis. And here we've got the oil shock. And that oil shock was not necessarily great for stocks. Stock prices went down by roughly 50% during that crisis relative to the monetary base. But just eyeball those two charts. How much of a connection do they actually really have? For example, we had this little micro shock over here. That's where oil went up 150%. How did stock prices do during that time? They went slightly down. But then we had a phase where oil prices went up by 200%. And during the same time period, stocks went up. And then we had oil coming down, stocks went down as well. So no negative correlation over here. And so maybe we have to look at this slightly differently. We've got phases where the oil price is comparatively low, and we've got phases where the oil price is comparatively high. This period from 2005 to 2015, that period wasn't that great for the stock market either. The S&P 500 relative to the money supply over those 10 years tended to rather go down. Again, because there was the global financial crisis in the meantime. While oil prices are comparatively low though, the S&P 500 has an easier time to outperform. The connection is not very strong, but oil definitely does have its impact if the price movements are large enough, which they currently are not. Again, this is oil relative to the money supply, and it barely moved. We are very far away from a real crisis. The Strait of Hormuz does not create a major crisis. Now, there's also a more long-term effect, because stock prices nowadays, I believe, aren't as much coupled anymore to the oil price as they used to be. In the old days, a lot of the production was just coupled to energy prices. But nowadays, most of the value creation happens through technology. And technology doesn't necessarily need oil. It needs energy, but it doesn't necessarily need as much oil. This chart was probably not on your bingo card. I made it for this video and I think the insights are very interesting. This is the S&P 500 divided by the US oil price. It's a very long-term chart. It starts in 1879. So this is 150 years of data. And for the first 100 years of those 150, the S&P 500 tended to move in line with US oil. When US oil prices go high enough, right, the oil crisis in the 1970s, then the stock market crashes, relatively speaking. And we can see how we just tended to trade in that range and how that crash brought us back to valuations 100 years ago. But over the last 40 to 50 years, there seems to have been a decoupling. Now, we can't really know what happens if oil was to go up by another 2 or 3x. If we actually saw such a major crisis again. We don't really know that right now. Things aren't really as bad. But here's my thesis. I think more and more of the value creation is independent of oil prices now. Have a look at the Nasdaq 100 relative to the S&P 500. So how do technology stocks perform relative to the rest of the stock market? Over the last 40 years, this trended upwards. Yes, we had our .com bubble and subsequent collapse of that bubble. But very long-term, technology stocks tend to outperform other stocks by roughly 5% per annum. In other words, technology becomes a more and more important part of the economy. Tech outgrows the rest. And so when we take that data, let's say the real expansion started in the 1980s, and this explains how the S&P 500 is able to outperform US oil. It's now decoupling from the oil price. Not by 100%. There's clearly still some impact, as we've seen from 2005 to 2014, but we are not in a regime of elevated oil prices right now. And if we were, maybe the S&P 500 goes sideways for a while again. But it might not crash as much anymore as it did in the 1970s, simply because of the wealth generation happening through technology. Technology can take other energy sources. It doesn't necessarily need as much oil. I go into more depth in the premium membership. So this is where I share what kind of trading strategies I use, how I construct my portfolio, how I see macro developments. Feel free to check out premium. There's a 7-day money back guarantee. If you don't like what you see, just message me within the first 7 days and I'll refund you. I also share my trades in real time. This is my track record with all of the trades, with the individual proof of every single one of those trades. So all of those trades have been announced in real time. For example, here, a short of the Trump token that I subsequently closed over here. So it all can be checked. It all can be verified. This is over the last 2 years, an average gain per trade of more than 5% with an average holding duration of a bit under a month. So again, feel free to check it out. There is a 7-day money back guarantee. Just message me over here in case you don't want to stay long term. If it's your first time here, feel free to subscribe. I publish this regularly. A like would be very much appreciated as well. It helps the channel grow. See you next time here on YouTube or see you on Premium. Link to Premium pops up here on the screen. Thanks for watching. Cheers.